Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive in there, take a look, see what people are sharing. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com. I dive deeper into all these sectors, topics, looking for individual companies to invest in. And you guys can see my portfolio. You can interact with me directly through the Discord that we have and also through the question and answer sessions that we have on the weekend. I do midweek updates on Wednesdays. Mayday coupon code is still active. So Brandon says, yet another reason why gold, silver, junior miners remain cheap. Sell-side analysts don't even recognize the current gold price in their sensitivity tables. I've seen a lot of tables stop around $2,200, $2,300 an ounce. The extra $500 to $600 an ounce adds up. Well, the one thing I will say is that the mining companies and all these commodity companies, they make their money not by prices spiking, but it's the average price that they sell their commodities for during a period of time. So it is the volume that they produce and the price that they sell it at. And if you have a spike, those spikes don't necessarily help their margins. So what people are doing is they're speculating on, is gold going to stay at $2,600, $2,700 or higher? If that's the case and the market has it wrong, then all of these companies need to be repriced vastly. If the price goes back down, then the $2,200, $2,300 per ounce tables may make more sense. So in order for the mining companies to make money, you need the price to stay high, not just surge and come back down. So it's a function of volume sold at a certain price over time. That's really what it is. So I think people are hesitant to change these tables dramatically, and then the price come back down. So people are just hesitant. So that's really what you're facing. You're facing a bearish sentiment still because people may not believe the move, and that is part of the disbelief phase. We may still be in the disbelief phase for gold and a lot of other commodities, and people they don't believe that we are in a bull market yet. They don't believe it, and that disbelief phase. You guys have seen that chart, and I don't think I've got the chart pulled up, and I don't think I can yank it up too quick, but it's that disbelief phase. So here's something, and I want to talk about this. I just saw this. Someone tagged me on it. Might as well talk about it. So it says SPSW and BPT look interesting. And then this guy says, but it is down 6% today, again, also Friday. This is what I do, and this is why I'm a little bit different maybe. I don't use the price to determine if something is good or bad. So what this person is suggesting is that since it's down 6% on Friday and today, that maybe some of these companies are a bad investment. I would say you're doing it wrong the way that I do it. You're doing it wrong when you're looking at this. So you could say in the short term that we've got some downside momentum. Okay, you have downside momentum, but that doesn't mean that the companies that are out there are bad investments. So you can have a disconnect between the value of the company and then the price of the company. And what this person is basically stating is that since the price of the company is down, that it is bad. But that doesn't determine the value. So you want to find the disconnect in the stock where you've got a disconnect between the value and the price. But that doesn't mean the price will go up every day, and it doesn't mean that the price hasn't bottomed yet. You could still go down with price, even though the value of the stock or business could be way higher than the price of it. We want to take advantage of that disconnect. Then we want to look at what do these companies produce. And if the company produces something that is coming into favorability, maybe it's gold, maybe it's silver, maybe it is uranium, maybe it's oil. It doesn't matter what it is. If you're bullish on it and you have a bullish stance that you think that the price of the commodity will go up, you want to buy the company when it's underpriced. Now, are you going to be perfect when you buy it? You're not going to be perfect. You're going to have volatility and things will go against you at some point in your investing experience. So I don't say that if something goes down 6% that it's bad or good. It doesn't matter. It does not matter. What you want is you want a cheap price. And then when you find the cheap price, then obviously you want technicals that look good. And using this example here, I don't think the technicals look that bad on this company here. I don't think it looks that bad. It's doing a retest, in my opinion. And then what you also want to do is you don't want to just limit yourself to this one company. Look at the sector. Where's the price? And I'm going to just tell you, the price is sitting on the cost curve of those commodities for some of the commodities that that company sells. If it's sitting on the cost curve, well, how much lower can it go? The larger companies in that sector are also pulling back production. They've already done it. They've done layoffs. You need to know all that stuff. So is this company bad, even though you know that basically they've cut back production, you're at the cost curve, and more than likely, you're probably going to see a move higher within the next 6 months or a year? Yeah, I think it's going to look good. I think it's a great setup. Insider buys this morning in Canadian oil and gas. We've got Cenovus Energy, Jeff Lawson, 4,000 shares. Tamarack Valley Energy, Steve buys 3,050 shares for himself, 308 for spouse Stephanie. Well, it looks like he got a lot more shares for himself than his spouse. And I don't know if there's limits or whatever's going on there, but that's what's going on. And generally, when insiders are buying, and there's been a lot of insider buying across the board in oil and gas, makes me pretty bullish on the sector. Now, are these guys going to be 100% right in the short term? No, they might not be in the short term. But guess what they're probably looking at? They're probably seeing increased sales. That's why they're gonna buy now before that occurs. They're probably seeing a bottom in activity. Again, these guys are in the industry, and we're seeing a lot of insider buys across the board. So I like to see insider buying. I really do. What I don't like seeing is mass insider selling across sectors. That means it's probably getting close to the top. But that's not the case for oil. Coming down to Brandon, he says, I don't own enough silver, gold, or PGMs. Love to see it. It says it's official. Russian government starts buying palladium, platinum, and silver besides gold. So Russian Minfin proposes to keep spending on precious metals at 51.5 billion rubles in 2025. Start buying palladium. Yeah, that's pretty good. Now, this here and this company up here, they sell the same stuff. So that 6% down move is an opportunity, in my opinion, and I think these are all undervalued right now. Specifically, these two here, very undervalued, and they look very good from a charting perspective. So I think the tide is turning. Now, here's a good question. How much is enough silver, gold, and platinum group metals? Is there ever an enough amount? I don't know what that is. For me, it's whatever I can sleep at night, and I can sleep just fine at night. When I didn't own precious metals or what I thought was enough, I didn't sleep well at night. I was like, I need to get more. I need to get more. And I think for every person, that's a different amount. But for me, I think it was a pretty high amount for me to have where I felt like it was good. What I try to strive for is I want enough physical metals where if gold goes up or silver goes up or platinum or whatever, that my entire other portfolio is just like cherry on the top. So I make enough from my investments of the physical metals, and then everything in my brokerage accounts and retirement accounts, that's just all cherry on the top. So that's the way that I view it. Obviously, other people are completely different than that. They think holding a few percent of physical is good enough, and maybe that is. Maybe that's the case. I just see it as too good of a risk reward opportunity. The rewards are pretty dang good. Last bull market, the big bull market in the 70s, gold went up like 25x. Silver did a 50x. Tell me, with the risk that gold and silver has, what can beat that on a risk reward basis? And I can't tell you much. I don't know if there's anything. And don't give me the crap of Bitcoin, guys. Don't give me that crap. Coming up, the chart hints at the greatest silver opportunity in 50 years, and hence that's my silver risk reward. This cannot be unseen. Silver's pathway to over $100. It's breaking out right now here, guys. Hopefully, we get a good, strong close on the yearly candlestick. That's all I'll say. Cornerstone Analytics says, and global oil demand jumped 3 million barrels per day during July year over year. Oil demand clearly hasn't collapsed, and historically, it continues ramping into year end. Don't believe the media's bearish hype, in his opinion. So, U.S. oil demand grew to highest seasonal levels since 2019 in July, EIA data shows. So, it's not, the demand isn't collapsing. Why is the price low? I don't know. Maybe because we've got an election coming up, and maybe there's some crap going on in the background that I don't know, or maybe people just don't know, or maybe they do know. Maybe they know, and the traders aren't taking long bets because they know that they're going to hold it down. I don't know. Brady says this commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. Every parameter I can think of is in place for the greatest bull of all time. End of the rainbow stuff. Maximize income, minimize consumption, and play it the right way. I like it, guys. I like it. I agree with them. I think commodities they're good. Visualizing the U.S. shale revolution, which helped to make the U.S. the largest oil exporter on earth. So here's shale gas. So you can see that we were struggling in 2005 or so. So we were coming down, and shale gas really killed it. We have shale oil that did real well too. And then everything else, conventional oil, conventional gas, and NGPLs. NGPLs looks like they've grown a little bit, but conventional oil and gas have definitely shrank since 2000. You can see 8.5, and this was 19.7, 11.7 down to 9.4, and then again, shale oil and gas were the big growers. There is a lot of talk around shale oil potentially slowing down or peaking soon, and that's something to watch because that's where the majority of the growth, if you look at the size of this growth here, it all came from shale oil and shale gas, and then NGPLs, those are your natural gas, probably other liquids, propanes or whatever, 2.6 to 8.4, that's coming from shale. So it's all coming from shale in America. And if that starts to slow down or peak, watch out. Technology. A lot of people say, well, we just need better technology. Yes and no. Technology is going to help shale oil and shale gas, but that didn't reverse conventional oil. I'm sure technology today in 2023 is better than 2000. Then why did conventional oil go from 11.7 to 9.4? So are we going to continue to find new areas of oil and gas? I don't know. Maybe, maybe not, based off technology. Had not seen a map with data centers as percent of power consumption. So I thought this was kind of cool. But this is the grid data center share of total power consumption in 2023. So the red, the data centers in Wyoming, Nebraska, Iowa, North Dakota, Oregon, and Virginia. Very large data center consumption of total power. They're all in the red. Other areas, Arizona, Utah, Nevada look pretty interesting over here for data center percent total electricity consumption. Breakwave says freight futures AM update, dry bulk up 2% for Capesize, 1% Panamax, and then tankers VLCCs up 1%, Suezmax is flat. We've got weekly insider buying. This is the silver and gold companies, mainly silver here. Aftermath silver and outcrop silver taking the metals here of insider buying, and a lot of insider buying in relationship to how big these companies are. That's a lot compared to the market caps. And then we've got some other ones down here too. Vizsla, Silvercorp, but not nearly the same dollar value. Warren Buffett on diversification, 75% of the portfolio. So I want to talk about this. Let's read it real quick, and then I want to make some comments on this. So you guys, let me bring that down a little bit. It says, I have two views on diversification. If you are a professional and have confidence, then I would advocate lots of concentration. For everyone else, if it's not your game, participate in total diversification. The economy will do fine over time. Make sure you don't buy at the wrong price or the wrong time. That's what most people should do. Buy a cheap index fund and slowly dollar cost average into it. If you try to be just a little bit smart, spending an hour a week investing, you're liable to be really dumb. If it's your game, diversification doesn't make sense. It's crazy to put your money into the 20th choice rather than your first choice. LeBron James analogy. If you have LeBron James on your team, don't take him out of the game just to make room for someone else. If you have a harem of 40 women, you never really get to know any of them well. Charlie and I operated mostly with 5 positions. If I were running 50, 100, 200 million, I would have 80% in 5 positions with 25% for the largest. In 1964, I found a position I was willing to go heavier into, up to 40%. I told investors they could pull their money out. None did. The position was American Express after the Salad Oil scandal. In 1951, I put the bulk of my net worth into Geico. Later in 1998, LTCM was in trouble. With the spread between the on-the-run versus off-the-run 30-year Treasury bonds, I would have been willing to put 75% of my portfolio into it. There were various times I would have gone up to 75% even in the past few years. If it's your game and you really know your business, you can load up. And that is Charlie and Warren Buffett's opinions on this. Now, the mining sector, I would say, is a little bit different because I would not put 75% of my position in one single company of a portfolio. The reason is there's a lot of risks that are outside of the company. So you could have a really good company. You could have everything line up for it. Let's say it's a developer. They got a CEO that's done this multiple times. They're in a very good jurisdiction. They've got a really good asset. 75% is still dangerous because there's things in the country that can go wrong that are outside the control of the company. And they can impact that investment massively. And depending on where it's located, you could also have problems with the country. Like we went to war or going to war, whatever you want to call it, with Russia, and I had Russian investments, and they're gone. Like they're frozen or gone is what I'll say. So that could happen. Now, I didn't have huge positions in it because I protected myself with my position size. You can't really do this, in my opinion, with commodity companies, and he doesn't do that with commodity companies. He does that with companies that are non-tech companies that are just they're sold down in some fear event, and then he loads up on them in some sort of event, and he buys a whole bunch of whatever company when the fear is maximized in the in the world or in the sector that he's in. He buys a bunch and then waits for the market conditions to come back around in favor, and then that gets repriced. But he's choosing companies that control their selling price and do not have jurisdictional risk, like a mine does. It's a little bit different. Rare earths, I've got this Wyckoff accumulation pattern. Looks very similar, like we're in the LPS region down here. The LPS looks very similar to the LPS region right in here. We have a down, up, so here's your double bottom, and then it comes up, and then sometimes it lags down below. That's exactly what we have, double bottom, and then it's coming lagging below. It looks really good for a potential entry point, actually. And there's individual companies that we can look at, too, in rare earths, if you guys want to, on the website. Lithium, too, looks really good. We got lithium going for a retest bounce on the long term, so this is your bottom, breakout, and then a retest. And there are some companies I do like. and I'll bring those up. I brought them up during the midweek update. They're on the website, and I'll bring them up again. Hydrogen demand for platinum. So projected platinum deficits also on here. So this is projected share of hydrogen-related platinum demand going from 2022 onward. Big move up potentially if more of the hydrogen stuff is adopted. Big platinum demand. And then looking at the deficit. So this is the platinum market balance in thousand of ounces. 2021, 2022, and this is a forecast going forward for 23 and onward. But this was done in 2023. And it's the only one I could find. So we're going to have a 1,000,000 ounce deficit in 2024. So this is going to be all the way down here. And these are what I want to get across here is that there's deficits projected out in the future for platinum. That's really what I'm trying to get across. Platinum for palladium substitution going down. So that's from Technopedia. Automotive substitution, and you can see they're substituting it greater and greater amounts. They're substituting platinum for palladium. So this is good for platinum, and it will increase demand for platinum and potentially impact those deficits in the future. Global money supply continuing to rip higher. This is the stimulus that they're putting into the system. This is your big move higher, and then the rollover here. This rollover, I don't know if you guys see this, but if you really stare at this chart here, this pattern here, it's like the same pattern almost that we have in a lot of oil companies. But the oil company started in 2020, but it's the same pattern. It comes on up, and then you get these two little humps there before a big move up. And we're like right at the bottom of the second hump for a lot of oil companies. Just wanted to bring that up. Nostra says, commodities are soaring again in China, led by iron ore plus 12%. Powell's cutting rates right into the second wave of inflation. Yeah, he is. That's exactly what he's doing. Here's another one that says, there's not enough marginal physical gold in the world today at the price of $2,700 if half of the world's private equity funds allocate 5% into gold. It's true. There isn't. There isn't. And this is 20% here is the gold allocation risk versus reward. 20% is the long-term sweet spot. There's no way you can have 20% allocation, guys. You just can't. Unless gold goes up dramatically. I mean dramatically. Where everybody holds 20% and it's accounted for in the dollar price. China tech stocks set to rip higher at the open of Hong Kong. Just look at these pre-market moves. Oh my goodness. Huge moves are happening over in China with that stimulus. And they're at the bottom of a recovery phase of the real estate market, which is really good for technology stocks. Gurgavian says, trading in the Chinese stock market has just crossed 1 trillion yuan in just 30 minutes after opening. This just broke all past records of being the fastest time ever. Wow, didn't know that. Global liquidity index just broke out. A monstrous bull run is coming. So what he's got there, this is probably for Bitcoin because these guys are all Bitcoin guys. But global liquidity index, you can see we're breaking out here of this downtrend. And we're probably going to see breakouts in a lot of different asset classes based off global liquidity. Constellation Energy CEO says, a lot of people don't talk about this, but in the 50 plus years since Eisenhower's famous speech, more people have been killed falling off rooftops installing solar panels than have ever been injured in industrial accidents at nuclear plants. So what's safer, solar or nuclear? Nuclear is safer. I'm glad that you guys came up with that answer because everyone installing the solar panels are at risk of being injured. Druk has said, the best economist I know is the stock market. Always took that to mean that that market prices, while incredibly imperfect, are the best window with which to glimpse into the future. Better than actual economists, even very smart ones filling out the survey. That is why I use technical analysis. That is what I'm using as the evidence or data in the system. And then I tie together a bunch of different sectors, areas to make that determination. And then I use the technical analysis because the best economist I know is the stock market or markets that are tertiary to it. In case you were sleeping the last few weeks, the printers definitely back on everywhere. the highest monthly number of rate cuts globally since the COVID month. So this is the biggest month of monetary easing since April of 2020. So March and April, and then you've got all these cuts and easing going on in the system. Just wanted to make sure you guys knew that, and that's AKA global liquidity breaking out to the upside. And that's all I'm going to say there. I think that's where I'm going to end it. Give me a thumb up for the content, subscribe to the channel, subscribe to the website, guys, and we'll catch you next time. This is Finding Value.